Okay. Yep. I know we're live. Yep. Okay. We're here. Sorry, guys. As I said, yeah, sorry about that. My my PC kind of crashed. I just took my kid's gaming computer and set everything back up really quick. Heart attack. So sorry for being late, but let's get rolling. Oh, that was fun. So anyways, Kyle, take it away while I catch my breath. Welcome, everyone. This is the first Thursday live stream. I guess we could have expected to have some issues, but we'll figure it out. Yeah. We'll be good going forward. Happy Thursday to you, buddy. How are you?
Happy Thursday. Doing great.
Good. All right. Kyle, you know this, or everyone who's been following along, congratulations on your beautiful baby girl. Exciting times.
Thank you so much. Yeah, it's been great. She's perfect. It's been awesome.
That's awesome. All right.
You just did the pictures where you put her on a quilt or something and put the 1 month. Yeah, nice. We're doing all that.
That's awesome. Absolutely awesome.
Yeah.
All right. So I'd love to catch up more, but we'll get moving. I respect people's times. We've got a lot to share with you. So let's get moving and bring you the Investor's Edge here, June 5th, 2025. Disclosures, definitely take a look at those. We are a registered investment advisor under the state of New York. Anything that we want to point out specifically, past performance, not indicative of future results, past results, not indicative of future performance, etc. Anything that we need to point out here?
That's it. This is for informational purposes. If you want personalized advice, that's something we would do on a one-on-one basis. So just for your information here today.
Yep. Excellent. Okay. All right. Sounds good. Let's get moving. Okay. So 3 things we're going to hit here. We're going to go a little quick. Just again, we're super late with all the tech issues that we had, but business updates, there's been a big transition between our 2 companies. We'll talk about that, market economy. And we just got done with a pretty significant portfolio overhaul, change of tactics, reallocation, readjustment, and we'll hit all those, guys. So, probably not a surprise at this point, but this is the week that I finally stepped away from the research business, trading analysis. It was bittersweet. It's the business that allowed us to be here at Inside Edge. Started in 2012, but it was always my goal to move full time into wealth management. So we just published our last video yesterday. And it's something that I use as sort of boots on the ground, observing the markets. But it was a little bit shorter oriented in trading time frames. I'm getting older, a little wiser, hopefully, and it's time to move on. So from trading analysis, we're officially now handing over to Inside Edge Capital Management. And I featured this in the video yesterday, but I think it's clear to restate our purpose here, our vision, and I'm just going to read it. Our mission is to deliver active portfolio management, comprehensive planning through transparent and continuously updated process. We believe the most effective way to capture alpha, which is returns above the benchmark, is by applying a disciplined step-by-step approach that integrates macroeconomic insights, fundamental research, and technical analysis. Strategies are informed by the same market tools that we used at TA, giving clients a deeper understanding of both the portfolios and broader market landscape. I think we're one of the few RIAs that combines, individual stock management, comprehensive, fully integrated financial planning, transparent education, and this is the very first example, of what we're going to be doing here weekly. And I promise we're going to be starting on time next week with no tech issues. We're going to show the good, the bad, the ugly. This isn't a sharp shooting exercise. Life in the markets is up and down and filled with volatility, and there's obviously a ton going on right now. So we're going to show you all of it in a transparent manner. So, the big news here on the business side is new Inside Edge is here. We have a brand new website that's like, would you say 95% done. We still have some things to update.
Something like that. Yeah.
Yeah. So we have a new investors page within Inside Edge that we'll talk about. Weekly live stream, here we are. Welcome to the team, Nick. You've probably spoken to him from TradingAnalysis. He's going to be joining us at Inside Edge. He's already here. He's a key guy. We have a new portfolio that we've launched over the last couple of months and a way for you to follow along called Active Opps. So there's a lot going on here. But let's jump in. Markets and economy. Kyle and I are going to be going back and forth here. I'm going to start off with some simple technicals, and then we're going to get into some fundamental and macro. And Kyle, stop me anywhere because I'm going to be going fast to try to make up some time here.
Great.
But at the market, the S&P, this is going back from the GFC, global financial crisis lows. You can see I remember the low. I remember trading it this day. It was a 666 low, scarily enough. And you can see the channel that we've been following on the upside, and the midline of the channel has been sort of the pivot point along the way. And the big sell-off we saw in April, that was this big intra-month move back up. And the technicals say that the market is still very much in a bull trend, cyclical bull trend. I think we test the upper channel line, which depends on the angle of ascent. Who knows? We'll see, but it might be north of 7,600 in the S&P. Who knows? It's not a projection; it's an observation. I'd also say that the RSI relative strength is no longer overbought. And it's nice to relieve that overbought status, which is kind of like recocking the gun for the next leg. The daily chart on the S&P, again, with everything that's going on with tariffs overhanging, we're only 3.5% from all-time highs. It's quite fantastic. Yields, I would say, with so much talk of coming inflation, tariffs being inflationary, that should be represented in move in rates. And here between the 10-year yield and the 2-year yield, 2-year very closely tracks where the Fed funds policy rate is. We've been mostly sideways here since late 22 into 23, and here we are in 24. So the little bit of divergence between the blues, which are 10s, and the black, which are 2s, is going to be your so-called yield curve differential. And right now with the 2-year yield at 3.8, the 10-year yield at 4.3, subtract those two, that gives you 50-something basis points of spread between the 10-2, and that's the shape. And longer-term yields should be higher than shorter-term yields in a healthy economy. And, with the two very close to each other, and they've started to diverge, as I said, creating a steeper yield curve. So that's a healthy sign. Kyle, you jumped in here. I think these are some of your slides. Why don't you hop in?
Yeah, just an update on how the next Fed meeting is looking here in a couple weeks. Month ago, there was a 27% chance of a rate cut, and now we're looking at a very small chance, under 1%. So just with the inflation still being a concern of the Fed, and unemployment looking good, they don't see the economy weakening yet, according to them. And so that's going to be the two things they look at when they decide whether they cut or not. So a month ago, it's a much different picture with inflation expectations and all that. What I did post something on this slide is that inflation did actually go down in the last read. So over April, it was a 2.1% year-over-year increase, down from 2.3. So
right.
By the Fed's own rules, if inflation were to get below 2, that would greatly increase the chance that we would see a rate cut sooner than later.
Yep. And I took your slide that you put in here and I updated it into the core PCE. So the PCE is the personal consumption expenditure, which is the Fed's preferred inflation gauge. What they like to do is focus on the core, which strips out food and energy. And I included the most recent reading, which is 2.5%. And as Kyle said, the Fed's target is 2%. So at the core level, excluding food and energy, which is quite volatile, We still have a little ways to go, but I think you can see we tried to emerge here over the last couple months of 2024, but then we've dropped away sharply at the core. So, pretty interesting trajectory there for inflation. And then Fed fund futures. If we do start dropping towards that 2%, could the Fed cut? Yeah. But I also think, the health of the economy is going to continue to see more of what we've seen, which is pushing the rate cuts back. So looks like we have 2 cuts priced in the Fed fund futures, one potentially in September, which, a couple months ago, they're looking at June, that got pushed back. And then they were looking in July, that got pushed back. Now the best odds, which are 97% chance of a September cut, we'll see if that gets pushed back. On hold in October and December. Actually, that'd be September, and then best odds are in October again. So 2 cuts, potentially. Go ahead, Kyle.
Yeah, a couple things. So, 4.25 is the current rate. Seems a little high if you have been watching rates, through the last 10 years, especially in the late teens. We saw very low rates, but believe it or not, the long-term average federal funds rate is 4.61%. So believe it or not, we are below average right now, even though, if you're looking at recent rates, it might seem high relative to, what we were seeing in the 2s and back of, before the pandemic, basically.
Yeah, that was interesting. I didn't know the average Fed funds was 4.6. That was a good pickup. I like that.
Yeah.
Yeah, and you put this one together very nicely. I think when you captured the slide 2 days ago, we were 27% chance of recession. We bumped up a little bit to 30, but we're a far cry from the 71% chance of a recession up here. And what are you saying here?
Yep.
Not out of the woods. This was an interesting point you said here in 1990.
Yeah, and this updated chart, I'm not seeing the gray. Usually the chart's shaded gray when we go into recession.
Yep.
But I can explain it. All of these peaks that you can see, most all of them above 25%, those were accompanied by an actual recession, except for one, and that was the 1991 there, where we went up to a 30% chance. And there was no recession, just that one time. So
that was the start of the Gulf War, I think, right? It was the first Gulf War, so maybe unexpected push into recession. Interesting. Yeah, no, and I changed that chart on you. And again, today was such a shotgun just ahead of our first presentation. So we're going to tighten it up going forward, and that's all on me. But all right, good stuff there. Let me pick up on this if you don't mind.
Sure.
Right now, we're showing here the SPY and the NASDAQ. We're going to get individual stocks and then the idea of Mag 7, so the Magnificent 7. It's been an unbelievable run here. I showed the return of the Mag 7 ETF since I think it was about April of 23 when it was first invented. It's up 119%, where the S&P is up 49%. But there has been some pretty significant underperformance this year of the Mag 7, okay? Now, it's going to be obviously Nvidia, Microsoft, Apple, Amazon, Google, Tesla, and Meta are going to be the Mag 7 if I got them all. So the Mag 7 is the purple in the beginning of the year, and the underperformance that Kyle is pointing at is shown here in purple. The SPY is in orange, so the S&P 500 is in orange, up 1.99% for the year. And then this is the S&P X Mag 7 without the large cap 7, up 4.64% for the year. So I would say, yeah, we're starting to get Mag 7 underperformance year to date compared to the S&P and the S&P X Mag 7, obviously. But, Kyle, you put that slide together and it got me thinking. I was like, okay, are they starting to come back? And if you take a percent change from the April low in the market, which is right here. This is the exact April, I forgot which exact date it was, but the Mag 7, the largest 7 market cap, is up 27.68% since April, where the S&P is up 18 and S&P X Mag 7 is up 15. So yeah, they're down and they're lagging for the year, but if the recovery is any indication of sign of things to come, does that continue? What do you think?
Yeah, the trend could definitely still be intact.
Yeah,
I think. I mean, and it's you put it relative to 2023 with Nvidia and 2024, and it doesn't look like a lot for Nvidia, but they're up what 20 plus percent over the last year, and that's taking out their biggest that big appreciation that they had. So it's not that's nothing to sneeze at.
No. And what's interesting, at the same time, what's happened is Nvidia over the last 2 days has snuck above the market cap of Microsoft, and it did so a while ago of Apple. So now Nvidia, as of today, is the most valuable company in the United States, though it's only up 6.8% year to date. Microsoft's up 11%. Apple's down 18% for the year, which we did cut our holdings, reduced our holdings in Apple. And then, you look at Meta, you look at Broadcom. Broadcom actually reports earnings. Broadcom earnings should be out, so I'm interested to see what those are. And then I wanted to include Netflix in there. Netflix up 40% for the year. The stock is ripping, another one that we hold.
It is.
Go ahead.
And then I was just going to say Tesla with the soap opera today is down big.
Oh my gosh. I knew those two were going to fall out. I was like, there's no way this is going to last. The bromance that they had, I was like, they're going to have it out.
Yeah, it's playing out like a Hallmark movie right now.
Go ahead.
Yeah, Nvidia, we still hold it. We feel good about it. It's going to continue to grow a lot. There's so much technology infrastructure being powered by Nvidia and so much to come. We've talked about how they, AI has originated in the tech industry with these companies, bringing it online, developing it, making it, something that they can sell and market. And now it's getting to the point where it's transforming different industries like energy and all sorts of stuff. So we are very optimistic about it, not just from like the Nvidia standpoint, but if you look at those different industries, we think the companies that adopt AI effectively are going to be the best companies in those spaces too. So it's something like we think it's definitely a major growth catalyst going forward still. Absolutely. even with the crazy run.
Absolutely. Yeah. It's still trading at a reasonable valuation. And Nvidia came out with earnings, and it's interesting. Here's the growth trajectory of earnings. So this is going to be quarterly earnings. GAAP is in blue, generally accepted accounting principles, and non-GAAP is in like the off-white. You can see, since 23, you can see the EPS growing. This most recent quarter that was just reported, you can see a drop. And what's interesting is the margins. The gross margins that Nvidia runs is like 80%. It's insane. But when you get down to EBITDA or EBIT margins, they're at 63, 60, so on and so forth. We dropped down to 50% margin. And what happened is this is the chip export restrictions put on by the government, specifically the H20. And Nvidia goes down there and says, blah, blah, blah. As a result of the new requirements, Nvidia incurred a $4.5 billion charge in the first quarter associated with H20 excess inventory purchase obligations. The demand for H20 diminished. So they were short, and basically they were saying if they didn't have those restrictions and the $4.5 billion charge and related tax impact, the non-GAAP earnings would have been 96 cents a share. So 96 cents, which is right here. So a couple quarters prior, 61, 68, 81, 89, and then without the restrictions, we're going to 96. But what I find interesting, Kyle, is look where the analysts are projecting earnings to go in coming quarters: $1, $1.17, $1.33, $1.35. The market is expecting that restrictions come off. And Trump and Xi are, I guess, having productive talks, but the market's pricing in that those restrictions are going to come off, or Nvidia is going to come up with a shippable GPU that they can send to China that doesn't impact their.
By then, that would. Yeah, but like by then, that would be enough time for them to start to adapt if it looks like that's not going to happen with China.
Right. And again, those of you who saw this, the last trade analysis video yesterday, I already went over this. But the data center capex, what Kyle is saying, how it's not just hyperscaler Mag 7, big tech and company software companies who are buying GPUs. I mean, it's all industries right now. You have industrials, you have healthcare, you have financial companies all investing. I mean, even the even the endowment funds of major universities are starting to buy these GPUs as they're getting ready to train their students to be ready for the new work-life reality with AI. But you look at the projection of data center capex, capital expenditure. I mean, it's $250 billion, $500 million, and then up to $1 trillion in capex. And Nvidia's data center revenue, which is a huge amount already of their overall revenues, as I've outlined here. I mean, that just goes to show the potential growth possibility for Nvidia. Nvidia has the dominant position because I was explaining to my friends last night, like, who's a builder. I was like, what if you were a builder and your only supplier was the company that made the nails, the lumber, made the tools, and then the architect who uses software to design the house and pull everything together, that company also owns the software that can only be used to make the house and to lay out the architecture for it. So you have the physical goods, which is hardware, and you have the software. And it's just we don't see anything that's coming close to the dominant market position right now. Again, Kyle, interrupt me if there's anything you want to jump in.
Yeah, they're the graphics processing units they sell, the GPUs. They're 70% of the market for that worldwide market. Like that's
interesting.
That's a crazy number.
Crazy. And they can't go out and they can't do a lot of acquisitions. They can't, because then antitrust starts to really creep in. So what are they doing with that money? They're doing share repurchase. So they utilize $14 billion of cash for share repurchases in Q1 of 26. They still have $24 billion remaining of authorization at the end of the first quarter. So, and this was kind of a fun slide from the Nvidia earnings call. I mean, they're looking to power the robotic world, and Elon's going full in on robotics. And it's an economy going forward where we're going to start to take inanimate objects, anything mechanical, and we're going to put technology and intelligence in it and make it animate. So robots are going to be doing so much of our daily chores: mow the lawn, walk the dog. Nvidia is really getting involved in it. Tesla, Elon's all in on this. And again, I think, the reindustrialization of the U.S., I think that's what Trump is trying to do, bring that production back home. Because again, all in it, so many inanimate objects and whatever mechanicals in your house are going to have power in it. So, you combine this projection that comes from the Nvidia earnings call with the technicals. I mean, could this thing continue and break above the 1 year consolidation we've had and start to see 300, 400, 500, 600, 800? Who knows? I think it's entirely possible. It's not a prediction, but I can certainly see it. Also interesting was Meta did a deal with Constellation Energy. It's a 20-year agreement to buy nuclear power from Constellation. We have a whole right up here on Constellation. There's other hyperscalers, Amazon, Google, and Meta, who've done deals with them. And again, the administration is behind it to deregulate energy. There's hyperscalers who are securing contract, but the world is looking for power to literally power the AI boom. We don't hold Constellation in the portfolio, but I am showing you the three energy companies that we do hold that do touch it: Vistra, Oklo, and GE Vernova. We'll talk about this one quickly. And again, I'm going quickly to make up a little bit of time here. But VST, we've held in the portfolios for quite some time. Power generation retail electricity company. They did a $3.5 billion deal to buy, I think it was Harbor Energy, which gave them 4 nuclear reactors. And they're all doing these SMR, these small modular reactors, as a way to sort of get away from the regulatory issues and make the process a little simpler and safer. But Vistra, massive earnings growth, beautiful breakout here. If we can get through the 172 to 177 area, I don't see why we wouldn't try to retest the all-time highs. We're holding some, both in Active Opps and TAG, and I certainly would be looking to increase. This is Vistra again. VST has grown top-line revenue consistently since 2021. Here is your EPS, annual EPS since 2021. And I've overlaid on top of that free cash flow margin. So not only is the company growing earnings, investing in their infrastructure, they're doing solar, they're doing nuclear, and they're doing natural gas as well. So they're trying to get into the renewable energies that may be able to power AI. But they're doing so with this investment by keeping their free cash flow margins up. So you look at it going 25, 14, 16, 18. I mean, their percent growth is been pretty substantial here in this company. Okay, anything you want to hit on there before we get into the business side here? We're going to talk about the business at Inside Edge, the transition over, and then after that, we're going to turn off YouTube and we are going to speak to the investors. Kyle, anything you want to hit? You're mute.
Yep, I say we move on.
Okay. All right. Business update. So again, we've done, I think, some pretty fun things. We've been working really hard on one, sunsetting TradingAnalysis, which again, after 13 years is a big deal. But we have a lot of clients who are very actively involved in the stock market, and we still want to work with you, and we want to welcome those, and we're trying to find a way to transition them over to Inside Edge, and then hopefully, that's a small part of your portfolio. But then we talk longer term on the majority of the portfolio. So, we have a few different levels at Inside Edge. The main Inside Edge client, wealth management, financial planning client, would be here. We also have the option, if somebody does not want to, let's say, turn their accounts over to us, but they want the full financial planning experience, they want to keep their portfolios and do the portfolio adjustments themselves, we have an arrangement for that. And then at the lowest level is the Active Opps membership, which is a lower dollar that's similar to what we did at TradingAnalysis, but it's a portfolio that we offer at Inside Edge. So we'll talk about that a little bit. Go ahead. Yeah,
this is the Active Opps. Some details on Active Opps. Todd manages it on Savvy Trader, which is an app that we use to post whenever we make trades. And it's going to be a twice weekly video update from Todd on, how we're managing this, why we've done certain things, explaining recent moves and our outlook. This membership, again, it's going to be totally self-directed, and what you choose to, do with the trade alerts and the information is up to you. But this would be, a non-advisory relationship where you're just getting the trade and the position information from us and doing what you will. The other two, that's a full service wealth management relationship where, it's us advising you, one-on-one, knowing exactly what your situation is, and maintaining that highest, we call it a fiduciary standard, which basically just means, we're always going to act in your best interest. And as we'll continue to explain, that's exactly how we set the business up, is to be able to execute like as a fiduciary, as everyone should. So
right. Yeah, so Savvy Trader is a third-party company that is going to take over all the technology. It offers an app. You get a push notification, a text message. You get some research on it. And what we do basically is I will take the three. Oh, did we update those slides? Okay, yeah, let me go back over here. So the three main equity portfolios that we offer at Inside Edge: SIG, Strategic Income and Growth, TAG, and then Active Opps. As we say here, these are dividend-paying stocks that still demonstrate fundamental growth. TAG is more growth-oriented, trying to compete with the NASDAQ. Not as much turnover in these two, but as Kyle was saying, Active Opps, this is our speedboat. This is our quick portfolio. And again, it's for people who want to, roll their sleeves up and, maybe we put a trade on. We just bought Dutch Bros yesterday, BROS. Last I looked, it was up 6-7% today. Might we take profits here tomorrow, next week, possibly? So it's not tax efficient, but it's for people who want to stay very active in the stock market, and we can be net short. So savvy traders are saying is basically anytime I make a trade in Active Opps, which is a portfolio, it's a model that's currently has investor capital from Inside Edge in it. I will go and update it on Savvy Trader. So it's a way to keep tabs of Active Opps. So it's a really fun little, a thing. We don't recommend any more than 10 or 15% of your overall portfolio allocated to Active Opps, which again is viewable and trackable on Savvy Trader. But if it's something that you want to do, there's information right there. Okay.
Yeah, and then our middle tier. This is not a full service client where we manage your portfolios, but it's everything else that we do for clients. So you can see we have a few softwares that we use to provide a holistic, comprehensive financial plan to you that looks at everything. It includes the investment recommendations. It includes strategy. Recommendations on retirement, estate, and tax, and any other financial matters that you would expect an advisor to help you with. So this would be kind of the middle service tier where you want the guidance, you want the advisory relationship, but you want to be able to implement the investment recommendations yourself. With this, like Active Opps, we do have an online login where you can get access to the models as we update them and be able to implement everything yourself. While I'm saying you're clicking the button yourself, but we're still available with no cap on consultations to make sure that you're implementing things the way you need to be.
Yep, well said.
And then this would be the full wealth management client relationship with everything I mentioned. Plus, you can see one more logo on the right. That's for Charles Schwab. That's where we custody our client accounts. And this would just be you signing up and going through the whole process with us, and then allowing us to implement the portfolio recommendations and the ongoing management of your portfolio, and then any other account services dealing with Schwab. If you need anything, forms or anything done, we're full service in that regard too for all of our clients.
Excellent. Okay, we hit that one. So again, if it's something you don't want to go in the full Inside Edge experience or in the portfolio investor, which is everything but connecting your account at Charles Schwab to us, Active Opps is right there. Information if you are so inclined to be an active trader. Okay, so that's going to be the end of the public stream. We've never done this before, being that we started 15 minutes late. But what we're going to do is turn off YouTube, and we're going to go into the members area, investors area at Inside Edge, and talk about the new portfolio updates. And kind of take it from there. So thanks on YouTube. All the best. Thanks for hanging with us here on Thursday, Kyle. Good work. We will be back next week and going forward, and we're gonna talk about all sorts of different things here. So we're not constrained, and we'll have some fun. Closing thoughts to the public.
Yeah, we'll talk to you guys soon, and happy trading.
Nice. All right. So I'm gonna